Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. Milton Friedman was an American economist and statistician who received the 1976 Nobel Memorial Prize in Economic Sciences for his research on consumption analysis, monetary history, and the theory and complexity of stabilization policy. These are all core issues in today's economic environment. In a talk he gave in India in 1963, he made the quote shown here very famous, and I quote, "Inflation is always and everywhere a monetary phenomenon." In the most fundamental sense, this statement is accurate. However, even Friedman was very specific in further clarifying when he added he was referring to episodes of persistent inflation, since in the short run, supply shocks can also impact the price level. Frankly, I think today his clarification is as important as his foundational Austrian economic statement. We have experienced inflation initially driven by COVID-19 related supply chain shocks. However, that element has mostly reset. What we have been experiencing since 2021 is the direct result of his heralded research conclusion. This is primarily what I want to discuss in this session. We are in the midst of a major banking crisis. I believe it is the direct result of Friedman's famous quote. The net of the current banking crisis is 1. Biden's historic level of spending, which led to 2. Monetary-driven inflation, which resulted in 3. Exploding yields, which caused 4. The instability of the bank's core stabilizing asset, which is government treasury bonds. Since the post-World War II Bretton Woods Conference, the U.S. Treasury bonds, specifically the 10-year U.S. note, have been the global risk-free interest rate benchmark. This requires that it be maintained by responsible economic and fiscal policy management. The global Basel Bank Accords were built on this, which resulted in the U.S. government treasuries being a core block in establishing value-at-risk metrics, or VaR, capital adequacy ratios, and regulatory lending ratios, amongst other things. However, the Biden administration's $6 to $7.6 trillion spending shock since 2021 has resulted in the $1.9 trillion American Rescue Plan, projected to realistically involve $3.5 trillion in total spendings, the $740 billion Inflation Reduction Act, the $1.2 trillion infrastructure bill, the $280 billion CHIPS bill, the $200 billion of Ukraine military support, and the January $1.7 trillion omnibus bill. Then, in addition, we have the new $6.8 trillion budget submission, which was released the day before the banking crisis kicked off. All of this has simply been just too much for the banking sector to juggle before the carefully constructed stability metrics simply started tilting out of balance. In this context, I want to cover the items shown here. We all knew the Fed was going to break something before it stopped raising rates. The history of Fed policy has demonstrated that, almost without exception. I've shown this graphic before in the way of warning many times in my videos and newsletters. I particularly like this version by Lance Roberts of Real Investment Advice because he uses an exponential trend with corresponding supporting bands. It is good as any in graphically explaining why the Fed has been able to get the Fed funds rate as high as it has without having broken something earlier. It is higher than the linear trend lines had suggested. But the Fed has now clearly broken something, and as a result immediately rolled out the Bank Terminal Funding Program, or BTFP facility. What can only be called its panic adoption has already effectively removed a significant amount of what has been achieved by quantitative tightening, or QT, in reducing the Federal Reserve's balance sheet. This is a major liquidity injection, which is effectively returning to quantitative easing, or QE, in a stealth fashion without buying U.S. Treasury bonds and mortgage-backed securities. As most are aware, the rise in U.S. equity markets since the 2008 financial crisis has almost mirrored perfectly the growth in the Federal Reserve's bank's balance sheet, We have some divergence prior to the COVID-19 as the Fed tried again to wean the market off its addiction to liquidity injections, but that failed and was thrown aside with COVID-19. I sincerely caution everyone in believing this may mean we are off to the races again as the Fed capitulates on its rate hikes and is forced to begin taking them back down, or at least might start taking them down. Always the best technical guide to what the Fed will do is the actions of the 2-year Treasury note. It has abruptly plummeted in the last week in reaction to the unfolding banking crisis and suggests that pressures will be on the Fed to at least temporarily hold further Fed fund rate increases. The March FOMC announcement in this regard will be interpreted with unknowable conclusions. I think we will show as we go through the charts that the Fed is now trapped, and if history is any indication, they will follow the patterns they have in prior similar situations. Yes, as you will see, the Fed has been in this type of situation before, and we'll show you what it did each time. The wild card is the degree to which the banking sector has been destabilized globally. The degree is yet also unknowable. However, it is pretty certain we are closer to the beginning than the end, as we have smashed through major support levels. As the proprietary Matassi momentum indicator in the bottom pane shows here, we haven't seen this level of momentum breakage since the global COVID-19 shock. As a consequence, we should expect unintended consequences, collateral damage, and further breakage. The Fed is trapped because inflation hasn't come down fast enough versus the levels it has been increasing the Fed funds rate to. The gap is major. Without getting rates above the inflation rates, we will further lose control of inflation, even more than we presently have. The Fed can't drop rates without losing the complete confidence of the financial markets, which would result in spiking yields and a weakening dollar. Both would only compound the precarious position they are already in. The Fed must get the rate, which is still increasing on a month-over-month basis, down to 0% from its current 0.4%. Presently, that is a 4% annualized rate. The year-over-year rate must be lowered below the historically problematic 5% level we outlined in this year's thesis paper. Anything less on either metric or sticky inflation will likely only surge further if history is any indication. What is it that the Fed sees that the public may not? One is how the markets reacted to its policies changes in prior episodes, specifically during the 2008 crisis. I've expanded the chart on the Federal Reserve's balance sheet correlation I showed earlier to include 2008 highlighted in the bottom left corner. What is surprising then, and easily forgotten, is that when the Fed did start to increase its balance sheet in reaction to rapidly falling markets, the market reacted differently than we currently would expect. The equity markets only continue to fall further, despite the aggressive Fed liquidity injections. Note the crossing pattern. What the markets were saying is that structurally matters were worsening and liquidity was not the solution. Yes, it also needed to happen, but it wasn't the full solution needed. It was only a bandage when a major operation was required. When the situation has already advanced too far, then the measures required are both different and often much more dramatic. Is this the case now? Here I've overlaid gold pricing in turquoise onto our chart. Notice that gold exploded at that point in 2008. Likewise, notice that gold has spiked dramatically recently in the midst of the banking crisis. Yes, during risky times there is normally a flight to the safety of gold. No doubt this is at play, but it could be, and I suspect much more. Is the market concluding the Fed's monetary policies actually can't solely fix the problem? Does the market sense there is a major structural problem at play? Here I've overlaid high yield spreads onto the chart. We see that in 2008 that spreads suddenly went ballistic when the Fed started increasing liquidity. Again, on the right, today we are possibly seeing the same reaction about to occur. Besides some trends about to reemerge, we are also seeing new warnings. Energy and oil, as represented by the West Texas Intermediate Crude, WTIC, continues to weaken, signaling the expectations of a recession or significant slowdown. Economic weakness normally means layoffs and unemployment, which only build on the attacks Powell received during his recent Humphrey Hawkins testimony that were quite clear that the politicians have no stomach for rising unemployment going into what will be a very tough presidential campaign season. The yield curve spread of the 10-year yield Treasury minus the Fed funds rate pushed forward 12 months, then overlaid on the yearly percent change of the coincident economic indicators, is supporting the West Texas Intermediate crude falling, and that an economic slowing is both underway and should be expected to quickly worsen. Though I don't give a lot of weight to insider buying or selling, the consistent trending behavior suggests minimally there is little confidence with those that have inside views of their businesses, industry, or economy. They see troubling times ahead. We have mentioned this in our weekly newsletters, but we have clearly witnessed a shift from the markets tracking to the Fed balance sheet liquidity actions, so prevalent over the last decade, to markets tracking closely to the volatility of the bond markets through what is referred to as the MOVE Index. It seems that many indicators have reached levels not seen since prior major crisis periods. These periods often signal major trend changes or significantly worsening existing trends. We suspect it is the latter, and the market weakening we have witnessed since the beginning of 2022 may be about to get even worse. When we look at the inverse of the MOVE Index against equities, we see the tracking we have witnessed since the beginning of 2022. However, we recently have seen a major divergence. Either the bond market is about to go to sleep, or the market is about to correct quite steeply to close the gap with bond volatility. This reminds me of the Wile E. Coyote cartoon of him going off the cliff without realizing it, and it is about to dawn on him the position he has suddenly found himself in. My bet is actually that I expect the bond MOVE Index is about to worsen, leaving Wile E. Coyote in an even more precarious position. When the markets realize their basic understanding of what is going on is misplaced, this sort of chart occurs before there is often an abrupt rush for the exits and perceived safety. To tie a lot of what we have been discussing more tightly together, we examined a raft of charts going back to the 1960s and prior to the inflation era of the 80s to see when we might have had similar situations as of today. We looked at all the major market dislocations during this 60-year period. Two examples, both slightly different, but clearly with the same message, stood out with regard to what we might expect. One, the 2008 financial crisis specific to the banking situation and events, and two, the 1974 Nifty 50 market collapse and bear market when we kicked off the inflation era of the 70s. This is an illustration from the 2008 financial crisis prior to the major drop on the right. We have overlaid credit spreads to the S&P 500 price action and annotated major banking events. It starts with Bear Stearns' bankruptcy filing on the left and works towards the final collapse of Merrill Lynch, AIG, Lehman Brothers, and others, which finally pushed the market over the cliff on the right. There were all sorts of events in between, where actions were taken by the Fed to reduce rates in an attempt to stabilize the markets. Nevertheless, the markets only continued to weaken, with credit spreads widening, rating downgrades occurring, and bankruptcies, the like of A&B Financial and IndyMac occurring. The Fed was helpless. Monetary policy was not going to fix the problem through liquidity. It was a fundamentally broad-based solvency problem. Finally, with the sudden unexpected Lehman failure, credit spreads skyrocketed and the markets collapsed. But it was actually the removal of the mark-to-market accounting regulations for derivatives within the banks that eventually stopped the markets from their downward spiral. The highly questionable regulatory change basically addressed banking solvency, at least temporarily. The subsequent additional fix was the introduction of the never-before-used and tested liquidity pumping program called quantitative easing. Think of quantitative easing as a balloon with a hole in it, and you just pump air into the balloon at a faster rate than it is leaking to keep it both inflated and expanding further. Eventually, as you might surmise, the balloon hole will only rip wider under pressure, requiring further pumping until all the pumped air just simply directly rushes out the expanding hole. The balloon then abruptly collapses. I overlaid the 2008 market collapse to our current pattern as a timing and pattern reference. Here I have placed the 2008 period against what was happening with market price, inflation, and unemployment. I've highlighted the market collapse in pale orange in the middle where market price is in black. As we just saw, the Fed was steadily opening the liquidity spigot during this period, yet the markets continued to fall. In turquoise, we see unemployment started surging just before the Fed began its cuts, but it only accelerated. Inflation was not a problem then for the Fed to also fight, but we see it fell to even lower levels despite money pumping because the economy was so strongly impacted. When the solvency issues were addressed by stealth regulatory changes, the markets regained their footing, moved higher with QE pumping, and eventually employment began to recover. As bad as all this was, the Fed never had to deal with historic levels of inflation. To address that issue, we went back to the market crash of 1974. Remember, in this example, the banks were solid, the U.S. was an industrial giant, businesses were well-funded, and employment was not an issue. The U.S. had just experienced the nifty 50 bull market as major corporations expanded internationally, and the U.S. was exporting products globally with almost no competition. There was no China, Japan, Asian tigers, or other European threats. The real problem was the U.S. government's massive spending through national debt on the unfunded Vietnam War and President Johnson's Great Society, which subsequently forced President Nixon to take the U.S. off the gold standard in August of 1973. The result was unprecedented monetary inflation leading up to 1974. We have a very similar pattern, as we just saw. Like the old saying goes about asking a banker how they went bankrupt. He responded, slowly at first, then all of a sudden. Again, the problem was structural and not about liquidity. We see here that as the market fell in the 1974 bear market, inflation only got worse. This is as we would expect. More monetary liquidity only makes inflation worse. Inflation only started to fall in 1975 as the market started to recover. I've added unemployment to our chart, shown here in turquoise. It also rose as the markets fell and only began recovering after inflation began to subside. Something clearly changed in late 1974. Again, it was the fix that addressed the structural problem, though maybe only temporarily. That fix was the implementation of the petrodollar agreement with Saudi Arabia that was agreed to in June 1974 and which effectively banned fixing oil prices for the U.S., U.S. bond financing, interest rates, and U.S. dollar stability. That agreement, where oil would only be sold and bought globally in U.S. dollars, has lasted until very recently when Saudi Arabia abruptly walked away from it. We've highlighted the importance of this action on a number of occasions in our newsletters. This agreement has anchored the U.S.'s position to consume more than it produces despite ever-increasing trade and fiscal deficits for the last 50 years. Overlay this on top of everything we have seen so far, and it's pretty evident that the current situation will not be resolved by liquidity injections by the Fed, lower rates, nor more quantitative easing. That is why the current issues are not about to end quickly or easily. What can we further conclude? More bubbles are not going to fix the underlying problem, though frankly I fully expect the powers to be to try and orchestrate another one. It is not the purpose of this video to answer what the structural changes need to be to fix the problem, but rather more simply to assess what the Fed will do regarding monetary policy. In this year's thesis paper, I talked about a lot of this and what monetary, fiscal, and public policy must begin to realistically answer rather than just once again kicking the can down the road. We've entered what we have been terming the beta drought decade, which is likely to unfold in some manner as represented here. It will no doubt evolve differently than shown here, but the major elements will occur at some time and degree if not addressed. Expect the emerging regulatory state to answer many of the issues with something I will leave you with as simply financial repression 3. In the short term, watch for unemployment to soon explode from its current extremely low levels. As unemployment heads towards record levels, as we lay out in our thesis paper, the Fed will capitulate on its inflation fight. It will likely increase the inflation target to 3%, selling us on inflation coming down to that level while the unfolding recession begins to take its toll with disinflation. The Fed may not drop rates significantly in this cycle, but it is highly likely they are neither headed higher soon. The problem is not just solely U.S. monetary policy over the last decade. It is actually the absence of real political leadership and public policy through fiscal responsibility and new initiatives and investment. In the meantime, watch the expected carnival unfold, with wasted attempts to fix misunderstood problems with the wrong tools by transient elected or appointed people with no proven experience. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems, until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and overall global policy paralysis, which is worsening with global conflict daily. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not necessarily following what has traditionally been a true and tried approach. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2023 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.